seeing huge inflows into the ETFs. Massive demand for silver. And I think it probably is the most undervalued asset on the planet. But gold is getting the spotlight. Silver's kind of in the shadows. I just think that, look, we've talked a lot about what's going on behind the scenes, where China is quietly stockpiling both gold and silver through unofficial channels, enabling it to purchase silver without affecting the silver spot market. I think that's really where the mystery is, how much silver is being accumulated by countries like China. I think they're making a specific drive to accumulate stuff off exchange, even though we are seeing a lot of deliveries because it's a smaller market.
Some shifts in the bullion market happen quietly. Premiums inch up, inventory moves under the radar, options trades hint at larger undercurrents. But then come the weeks when the numbers shout, when vaults swell, when East and West diverge so clearly, it's impossible to ignore. This is one of those weeks. AndySchectman, CEO of Miles Franklin, says what's happening on the COMEX isn't a blip. It's structural. Physical delivery, once the exception, is now the rule. We're no longer talking about a handful of contracts here and there, he says. We're talking about thousands being stood for delivery month after month. Look at the numbers. As of July's close, silver stocks in COMEX vaults hit a record 506.7 million ounces. That isn't just a new high, it's a historic signal. On Thursday alone, 45 tons were added. Earlier in the week, 62 more. In just 2 days, the vaults took in more physical silver than some nations import in an entire year. But accumulation is only half the story. Schectman points to vault withdrawals, loadouts, as the part everyone should be watching. Significant sustained withdrawals typically indicate that the metal isn't being shuffled for arbitrage or short-term positioning. It's leaving the system. Whoever's buying wants it in hand, not in a vault, not on an exchange, off-grid. This is the most significant wave of physical accumulation the COMEX has seen since the post-COVID supply chain squeeze, and it's already blown past that benchmark. Institutional demand is unmistakable. But it's not just US-based players making moves. Schectman highlights what's happening in China, where silver premiums remain strong, currently 4.45% above the LBMA benchmark, or roughly $1.69 per ounce. That kind of premium signals real demand, strategic deliberate accumulation, not just speculative churn. And while supply flows into New York, the premium gap shows where the real pressure is building. East versus West. Futures contracts versus physical metal, and a vault system that, quietly or loudly, is being reshaped right in front of us. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We've talked about how significant the deliveries have been every single month. It's not an anomaly anymore. I mean, if you look at the COMEX delivery numbers, you go back to November, but look at them and they're extraordinary. Someone or some institutions have a very, very strong desire for physical delivery. So far, just through the first 3 days of the August contract, we saw 20,126 contracts stand for delivery. That's just in the first 3 days. That's let's just do the math. 20,126 times 100 ounce bars. So let's do that math here. 20,126 times 100, 2,012,600. Let's just call it times 3,400-ish. That works out to $6,842,840,000 worth of gold in the first 3 days of the delivery contract. Silver, this is not a major delivery month for it. We saw 1,064 contracts worth about just over 5.32 million ounces of silver. Each contract's 5,000 ounces. So again, in platinum, 1,006 contracts. Yes, that's 50,300 ounces. Each contract is 50 ounces. What's really significant, and these are very significant early numbers, especially with gold, seeing huge delivery volume in the month already. Well, this suggests strong demand for physical. And what's really interesting is so far, every contract that has been issued is settling in physical metal, indicating the real demand. And it's like a 1-to-1 ratio. This is significant because you rarely see that happen in COMEX. I've mentioned that to you in years before that, futures contracts are usually closed out before delivery. They're traded for profit or settled in cash. When contracts are stopped, which is what the lingo they use, that means that the physical metal is actually changing hands. Now, in terms of how much is leaving the exchange, a lot. Not all of it, but a lot is actually leaving the exchange. And August is one of the major months for gold, and you typically see higher open interest and delivery volume. But the strong intent to take physical metal where every single contract has been stopped, meaning buyers aren't shutting their positions, they're taking delivery, this is ridiculous. I mean, it's huge. But this is exactly what we've been seeing, the delivery volume and the vault withdrawals, the loadouts it's called. There's been steady outflows suggesting that loadouts are occurring relative to deliveries more so than ever before. And so I think it's really, really important. It's not a 1-to-1, but it's pretty damn close. And so silver supply, same thing. We're seeing huge deliveries. This isn't a primary delivery month for silver, but still huge delivery, and they're leaving. We're seeing huge inflows into the ETFs. Massive demand for silver, and I think it probably is the most undervalued asset on the planet. But gold is getting the spotlight. Silver's kind of in the shadows. I just think that, look, we've talked a lot about what's going on behind the scenes, where China is quietly stockpiling both gold and silver through unofficial channels, enabling it to purchase silver without affecting the silver spot market. I think that's really where the mystery is, how much silver is being accumulated by countries like China. I think they're making a specific drive to accumulate stuff off exchange, even though we are seeing a lot of deliveries because it's a smaller market. They're trying to keep it, I guess you could say, less apparent to the rest of the world what they're doing. So no, it's amazing the amount of gold that's been delivered in just the first 3 days. But this is what we've been talking about now every month since the beginning of the year, and it's showing no signs of slowing down. In fact, it's showing signs of increasing. China is suppressing with the West on paper to drive down the price and then accumulating it everywhere else around the globe where the price isn't affected by acquisition. So whether it be taking doré or concentrate from the miners directly, which completely disintermediates the market, they can also buy it off of exchanges and on platforms throughout the globe where price isn't determinant upon offtake, as it would be in London or in New York. So they suppress the paper price and then go buy it everywhere through sovereign wealth funds. I wouldn't be surprised if they're buying coins too, and all sorts of things, whatever amount they can get where it doesn't cause the price to move or any attention gleaned upon them. Yeah, I think that's exactly what they're doing, and it's a great model. They're using the suppression of the Western system against us, as we've said over and over and over again. And you can see it very clearly, especially when you see the amount of gold and silver that they are accumulating. Their numbers of gold are off the charts right now. In fact, I think what's coming in is the record numbers that they're reporting. I would argue a large portion of what they have and what they purchase and what they bring in, and certainly what they produce, is not reported to the IMF. Why would they want to do that any more than we report what's held inside of Fort Knox?
Physical silver demand isn't cooling, it's firming up. Vault flows in both the US and Asia continue to confirm what prices alone won't tell you. Physical buyers haven't stepped back. If anything, they're getting more aggressive. At the same time, option markets are offering cheap exposure for those who understand what's brewing beneath the surface. In China, despite regulatory uncertainty, silver and gold premiums continue to show a positive trend. The bid hasn't gone anywhere. AndySchectman doesn't mince words. Every month, physical metals are being pulled off the exchange in volumes that point to serious coordinated accumulation, he says. And he's not just talking about retail investors hedging inflation. This is bigger, it's methodical, it's strategic. Then there's what's happening in equities. The exodus isn't subtle anymore. Insiders are getting out, and not in small doses. Jeff Bezos has unloaded $6 billion in stock since June. Jamie Dimon, Warren Buffett, Mark Zuckerberg, they're all showing the same hand. This isn't a case of retail panic or sporadic selling. According to Schectman, institutional selling is running at about $2 billion per week. That's not trimming risk, that's abandoning ship. Bloomberg's data backs it up. Zuckerberg, Oracle's Safra Catz, and Dimon all dumped prominent positions while valuations were still holding. Then came April 2nd. Trump's new tariffs took effect, and tech stocks began to slide. The timing from those insiders was surgical. They sold before the headlines, before the dip, before the markets caught on. Let's get back to the interview.
I really do believe that what they are trying to do, what Besant is trying to do, is to peg the front end of the market, of the bond market, to the stablecoin volume. And it's the fact that the issuance of stablecoins, which I think will blow people away, will grow and grow and grow and grow. In fact, I think you'll see corporations all over the globe issuing them, tied into the system, and they'll be able to, which will then all be backed by U.S. Treasuries. But he said stablecoins will create $2 trillion of demand for U.S. Treasuries. And his comment was, we are going big on digital assets. Now, it's funny, the name of my podcast that I do personally, not the one with Michelle, but the one that I do is Little by Little, speaking to logarithmic decay, little by little, then all at once. But think back a few years ago, Bitcoin was there, and now everything is here. And stablecoins, what were stablecoins a few years ago? And now we're going big on digital assets. And they're going to load up all of those stablecoin, the backing of it, which will be treasured, all be short-term debt, less than 2 years, because the rates will be much lower on that. That's how they keep the engine moving. And then we talked about revaluing gold to devalue the dollar, backing the long-term treasury with gold, redeemable in gold, as Judy Shelton says, so that the rates are very low, if not nothing, zero coupon, redeemable in gold, which acts as the inflation hedge to reshore your manufacturing. But this is big. Okay, this kind of leads to fiscal dominance, because what it really does is it narrows the Fed's dual mandate, because it will be the U.S. Treasury that will track where and when U.S. Treasury bonds are sold to deliver stablecoins. And so it will be a far greater impact for the U.S. Treasury than it will for the Federal Reserve, who I think has a much greater say on things right now. And this, from that standpoint, is something that I think certainly the administration would like. But, look, this will radically empower, I think, the Treasury, and it will reduce the power of the Federal Reserve. To me, that's part of the reason they're doing it. They say, end the Fed. Well, no, but what this will do is because they are going, in my belief, they will allow any corporation that wants to issue stablecoins anywhere around the globe will most likely be able to issue them. And they will all be back with treasuries. It's not just the banks. They'll let major corporations issue them in order to pay for things easier, in order to do cross-border payments easier in 7 seconds instead of 3 to 5 days. This is a quiet play towards fiscal dominance. And look, the Treasury needs lowered rates, and they need a way to market the treasuries when no one wants to buy them. How do you do that? Well, you create a synthetic demand by backing the front end of the curve with stable coins. And then you allow all these institutions and corporations and banks to issue them in the name of convenience and liquidity and expediency. But what you've just done is create the most synthetic demand ever for the U.S. Treasury market, which is debt. And they call it a stable coin that's backed by debt. Does that seem stable to you? It doesn't really seem that stable to me. And it just continues to go. The stable coins back the debt, which enables you to buy more stable coins, which backs more debt, and on and on and on and on. And it's kind of a house of cards. But the long end of the curve, which is the more important end, so this keeps the engine running, will have zero coupon and redeemable in gold. And if you devalue the dollar by revaluing gold to a much higher level, to reliquify the Treasury General Account, to devalue the dollar, yes, you have inflation. Yes, you have a devalued dollar. Yes, it's not good for the average person. But what it will do is will enable us at very, very inexpensive rates to bring our manufacturing back with that devalued dollar. It will enable us to have demand for our new exports. But what this says to me, then again, they don't want to be the world reserve anymore. And that's when you see, Vance come out a year ago, almost 6 months ago, and say, being the world reserve currency at this stage of the game isn't a benefit anymore, more or less. And he's speaking to Treffin's dilemma, which we've talked about. But anyways, bottom line is, when you see him coming out and saying, we're going to go big time, this is all about, A, taking a lot of power away from the Fed and moving into the Treasury, B, having a need for lowered rates and having the synthetic demand for your treasuries. All of this would be accomplished by this massive embracing of stablecoins, which just a couple of years ago, if I would have bet you $1 million, you'd say there's not a chance in hell that this is going to happen. And here we are. So, and more we see things that just keep happening that, look, the U.S. Treasury just announced on Monday that it needs to borrow just, what's the number? 1.007 trillion in privately held net marketable debt. That's treasuries. 1 trillion. But they told us in April they'd only need about 550 billion or so. So it's 450 billion higher than was announced in April, just for July through September, for the quarter. So we're burning through cash at such a rate, it's unbelievable. So if you are another country, why would you want to own our treasuries where we're inflating this way when our treasuries can be weaponized? And the whole mandate or goal of Trump is to reshore our manufacturing to compete with the countries who are buying our treasuries. Well, no, I'm not going to do that. I'm not going to fund you so that you can reinvest within your own ecosystem to build manufacturing to compete with us. The days of what am I trying to say? Organic demand for the Treasury have come to an end. And this is the answer that, it's pretty clever if you think about it, but this is exactly why Besson said we're going big on stablecoins.
What used to be background noise is now setting the tone. Between the vault movements, the premium spreads, and the sharp exits by corporate giants, there's a pattern forming, and it doesn't point to calm waters ahead. This isn't just about market cycles or seasonal quirks. It's about positioning, quiet, deliberate, and increasingly aggressive positioning by players who seem to know what's coming. When both physical metal and insider capital move this decisively, it's rarely accidental. It's preparation. How long can the illusion of normalcy hold when the most informed are already stepping away from the system? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.